Hello and welcome to Climb's podcast series Advancing Vietnam with me Vlad Savin as your host. Throughout the following episodes, we're looking to answering relevant questions about doing business in Vietnam. What are the opportunities and challenges faced by investors entering the market or existing players in major industries? We will seek to understand the business environment from a cultural, local mindset and how to deal with compliance from an international perspective. What are the major risks faced by businesses active in the region and how to overcome them? We will dive deep into the compliance environment in Vietnam, discussing processes and procedures, changes in laws, latest official updates from the authorities, and financial governance planning for businesses active in Vietnam. We at Climb consider compliance a major asset for foreign investors operating in Vietnam. We emphasize this aspect when speaking with our clients, and we make sure they understand the significant benefits of being compliant.
In this episode, I'm discussing with Matthew Lowry, managing partner at Climb Vietnam, about the key differences between foreign invested companies in Vietnam and locally owned entities, highlighting the benefits and risks of each type of structure and practical insights for choosing your market entry model in Vietnam. Matthew, welcome again to our Advancing Vietnam podcast series. Good to have you here.
Great to be here again, Vlad.
This topic has been historically highly debated among the casual business forums in Vietnam, where investors would often debate about the foreign versus local narrative, giving rise to quite a lot of misconceptions around the subject. Let's try to bring some light for our listeners.
Look forward to it.
Matthew, let's start first with the basic tools we need to obtain a good understanding on the two ownership structures. Can you share with our listeners what is the foreign-owned enterprise in Vietnam? What would be a simple definition for this ownership model and structure?
So I think the question is actually coming from a historic understanding, and realistically, there is no difference. That's the misunderstanding there is. There is a company, Vietnam Limited Liability Company, joint stock company. It can have foreign ownership, and that foreign ownership might be 100%, might be 1%. So whether you have foreign ownership is an ownership issue, it's not a structural issue. And that's where people get confused, because historically the need for joint ventures and the need for certain structures did exist, but that's over time gone out. So we just have a company and who owns that company.
Then let's start with the common process for setting up the foreign-owned enterprise in Vietnam, looking at steps and timeline. And let's look into key characteristics for this foreign-owned entity.
For a foreign invested company, meaning there it's a company with foreign investment, if it's more than 50% foreign owned, you need an IRC. So investment registration certificate is an application to establish or to acquire, to make a company majority foreign owned, and the IRC is effectively a foreign investment approval process. It's a business plan, it's a project approval, and it may require various ministries to be involved depending on the sector, but that's that foreign approval, so to speak. You then need an ERC, which is the Certificate of Incorporation, Enterprise Registration Certificate. Local companies without more than 50% foreign investment will only need the ERC. If it's majority foreign invested, you need the IRC as well. So that's probably the biggest distinction between foreign and local. You can have a foreign invested company with less than 50% that is still treated as foreign, but it doesn't need an IRC. It just can have a straight ERC because it is below the threshold.
So then, to summarize from a benefit perspective, this time having a foreign-owned entity in Vietnam, what would be the key points investors should take away from a benefit perspective?
Yeah, I look at it a different way. The benefits come from the need. So the need is, I'm buying a company, I'm going to buy it, because I think that, and we can talk in a moment about the issues with this concept, which I think you're getting at is, I can put it in a friend's name, a nominee name, I can put it in someone else's name, it's easier. Let's address that in a moment. But the idea of what comes out of that, if I'm a foreign investor, I'm the owner, I can receive the dividends. I can transfer the shares and get the proceeds, transfer the capital, get the proceeds offshore. So if I bring the money in correctly, I'm registered as the owner, I can take the profits out, I can take my capital out, I can take my gains back out of country. If it is done through the nominee structure, it's a local ownership, the money stays in the country, you don't have the ability to send out. That's fundamentally what decision that is being made when people are going, I'll just do it through a friend, it's quicker and easier. Forget the legalities, that trapped capital really does come to the fore, which is why it's not a benefits question, it's a structural question that has consequences from that structural choice.
Now, going back to the locally owned company in Vietnam, in what key ways is it different than the prior, and what is the common process for registering it if it's different than the foreign one?
So a standard company in Vietnam that doesn't have more than 50% foreign equity is just an application ERC. It doesn't have to get foreign investment approval. Now, if it's an existing company, there may be M&A approval requirements, there may be an IRC existence, etc. But let's assume it's not Vietnamese name, setting up a company, it's an ERC. There still may be restricted sectors, not many, but there still are some, and there still may be sub-licenses. So there may be, even on a simple business, if you're trying to do a valuations business, for example, you'll need to make sure you satisfy the requirements to get approval from the ministries to do that process. So there are extra complications that exist in any structure, but the ERC only means you can register your company. You don't need to seek investment approval, which is what a foreign invested company needs to do. And that's where people, when they make decisions, I can do a local company in a week because I just have that registration phase, the ERC, the Enterprise Registration Certificate. I don't have to do the IRC, the investment registration, the foreign approval. And that's why you see people go, I'll do a local company and I'll fix it later. That's what they're talking about, is that speed, that 5 weeks versus 1 week. And that's for a vanilla with no additional approvals. But that's sort of the decision making you're looking at.
And we'll talk a bit later about what fix it later means, and actually what that involves within the foreign investor structure and the future goals in the company.
Does it fix it? Yes, good question. Okay.
And what about from an ongoing compliance perspective? Are foreign and local companies treated differently by the authorities, looking at their taxation, labor compliance, reporting, and general corporate submissions to the authorities?
No, if you look at the law, they're a company. There is no difference. There are additional requirements that get triggered because of the ownership structure, but people get confused. Oh, it's easier for local, the tax is easier. No, it's identical. The laws are based around a company, not based around who owns it. So a company must lodge taxes, must do their filings. They are a company. Doesn't matter who owns it. The risks exist exactly the same. Where the additional lodgements come in is that you've got a compulsory audit for a foreign invested company or a company with foreign capital. You have additional audit requirements where a company without a foreign capital is not required to do an annual audit. It's optional. So that's the one thing which does have an impact. The second thing is there are additional reports based on investment reports that you have to submit as a foreign invested company that a local is not required. So they're more statistical related reports. So there's a number of those depending on what you're doing, depending upon your capital structure, depending upon sectors. There could be quite a few of those, could be very few of them. But it's those investment reports, the statistical reports that exist, and it's the audit. They're the predominant differences. But this suggestion that there's tax differences and company structure differences, no, a company's a company. And that's where the confusion arises, because it was different many, many years ago, where you didn't there was actually different laws and different structures depending if they're foreign and local, where they're just a company. And just the company and who is the investor.
Mm-hmm. And now let's look at the potential risks for a foreign investor when considering setting up a locally owned company in Vietnam. Speaking of how to fix it, so let's assume that a foreign investor is looking to undertake such a structure. What are those risks to highlight?
Okay, so let's assume the scenario, and we see this quite commonly. A foreign investor says, I'm in a hurry, I'll do it through a friend. A friend can be the owner, set it up for me and I'll buy it later. And that is common. Now, choice people make. The first issue with that is that there's no trustee law. There's no nominee law in Vietnam. And in fact, there are provisions in the current enterprise code for the authorities to deem that to be illegal and potentially take that investment away. We haven't seen that triggered, but the provisions are there to potentially do that. So there's no nominee law. The named owner is the owner. And no matter what documents you have, it's very hard to get a court in Vietnam. There are ways around that. There are technical ways, sophisticated ways we can do loans and mortgages and things to protect the investor. But first thing is, it's someone else's company, regardless of it's my company in a friend's name. If I was the foreign investor, it's the friends. It's for the purposes of the Vietnamese law, it's the friends. So you've got to keep that. That's the first. Then if you want to acquire that into a foreign structure, let's say you're in a hurry, you set up a local company, then you want to acquire that and the foreign investor requires that, you may require M&A approvals, the extra costs, You've then got IRC process and approvals, and in fact, the cost may be significantly higher to doing that than just setting up foreign in the first place. The total time frame you won't save any in totality, or take more time frame because you've introduced an extra step, which is the M&A approval to acquire the existing shares, which may not be required, but it may. So you've got potential higher cost and longer time frame than doing it straight up. And the last part is, and I think maybe where you're alluding to, is that if I set up through a company through a friend, gave them some money, they set it up for me, I have to buy that back off them. But I've already given them money. I have to bring money in from abroad. To be the foreign investor, you are committing to bring funds from abroad into Vietnam as a general rule. I have to bring that money in and buy my capital back off the local investor that I've probably lent money to in the first place to start the company on my behalf. So I've had to pay twice. And I can't take that second money back out of the country. I've got to ask my nominee, can you give that cash back to me, please? And hopefully they obviously would, because you've got a good nominee. But legally, you can't enforce that, most likely. But if you can get that money, you can't repatriate that, because those funds did not come through a foreign investment process in the first place, therefore trap funds. If it stays in the name of a local investor and you want to pay a dividend, you don't transfer to foreign, that dividend can't go offshore and it can't be paid to the benefit, which will own it with the foreign investor. It is of income to the local individual. And again, trap capital if you're a foreign investor. And those trap capital, or double payment and trap capital, can be painful, particularly where assets increase in value and you're stuck in a cycle you can't get out of.
Do any of these mentioned risks exist when setting up a foreign-owned company? And if not, are there any downsides or issues to consider for investors who choose to register from the beginning a foreign-owned company?
So a company with foreign investment is just, again, it's a different capital, who the contributing parties are to capital. So if you bring your money in correctly in the first place, your money's where it is. You don't have any trap capital. You pay once, it comes in properly. You can sell it to the foreigner. You can sell it to a local. You can get money back out. Your dividends are yours from day one. So you don't, and that's where this concept of foreign-owned, local-owned, no, it's who is the investor and did that investment come properly. So if you've got a local investor, they're local. You can't pretend they're foreign if you did a nominee, because the law doesn't reflect that. So it's always local, and that's where that a difference in perception is that. I'll nominee or fix it. Well, it's local investor, therefore it's trapped if it's foreign investor done properly. There's no, the difference is getting it right at the start, and there are no implications. There is a cost. So let's just be clear. There is a higher cost, a significantly higher cost, setting up a company with foreign investment than setting up a local company with local investment. That's the upfront cost because of the staging. If there are additional sub-licenses, etc., doesn't matter which side you're on, they're both going to be the same, but the actual approval process for setting up. But if you're going to transfer local to foreign, you may have just removed that benefit. And from a timing perspective, far quicker to do a local than a foreign, but if you're then going to transfer it later, you need to have a purpose for why you're urgent to do it now versus just doing it properly, because the time and effort's still going to probably be roughly the same in the end.
And speaking of purpose, following my next question, not all business lines are open for foreign investors, so for foreign ownership. And there are specific restrictions and conditions for certain industries and key sectors. What can investors do then when seeking to access the market in these areas, and what type of entity structure would make sense in these cases?
So you see, advertising is a typical example of that, where you can't have 100% foreign-owned advertising company. If you want to have foreign capital in a business with advertising license, you must have a local company that holds an advertising license as one of the investors. So we commonly see either Vietnamese individuals offering their services as a investor for a fee, effectively a nominee structure where they'll hold the local company with a license and say, I'll hold 1% capital, pay me some money and I'll be quiet and silent and I'll make sure you get 100%. So you see workaround structures. Now, there's different ways to do it, and creative advisors, creative investors will get around it. So the example of advertising, and I'm aware of these where a local investor, Vietnamese, will have a company and offer their investment services for a fee to basically be that nominee, but on paper, it's their company, it's their structure, it meets the requirements. So that's how you get around it. There are ways to do, if you're setting up a structure that for timing purposes, and for structural purposes, like maybe there's a 3-layer, because the law says that if I've got a foreign invested entity which owns an entity which owns an entity in Vietnam, so 3 layers, that bottom layer will be deemed to be Vietnamese for any further transactions. So it might buy a Vietnamese restricted business. Now, depending on what sector it is, it may not work, but that will be treated as a Vietnamese transaction. So I've seen groups that set up a locally owned to get a license that's restricted to sell under a 3-layer structure, or to get around like retail provisions where you have to do retail outlet license for every outlet, to put that structure under a 3-layer and to get around the provisions. And that they might have certain protections in the first stage to get that set up, but once they've got it set up, they'll throw it under the 3-layer structure, and that way it can be foreign owned. We've seen that. Now, that's again, unless it's a significant structure running all those empty companies and having to channel the dividends back up through those companies, can be a bit of a challenge, but that is, again, you've got to balance the risks and restrictions in Vietnam to get where you need to get to.
Matthew, you've been in Vietnam for over 17 years already, and you certainly witnessed many changes in the business environment. As you mentioned before, you mentioned that there was a time when investors could access the Vietnamese market only by partnering with local businesses, deeming their entity as local as well. However, the Vietnamese business environment has evolved significantly since then, and the support for direct foreign investments has been consistent and publicly promoted by the authorities. Do you still see a viable option for investors to choose locally owned entity route? And why would it make sense now at present from a business perspective?
So the old joint venture investment, you still hear it talked about, I need to set up a joint venture company. Well, that's old laws where you had to jointly invest, and you do a joint venture agreement, and the company will be structured under a joint venture arrangement. And that was old laws to allow foreign investment in Vietnam generally, where 100% foreign owned were very rare, possible under certain things, but not common. And you say people, I need a joint venture. No, you need a company with a local and foreign investor, 2 investors. One happens to be local and foreign, and then deal with the restrictions, if any. So the vernacular has changed, the laws changed. A lot of people's mindsets haven't when talking about this joint venture. So there's no requirement for a joint venture. There is provision you can do it, but that's not the approach that is taken. Why would you do a local company? As a foreign investor, you shouldn't, unless there is a very restrictive nature and a transactional path that it is part of the way to get the structure that you want. Keep in mind, there's no nominee law, there is no nominee beneficial ownership issues, that it's the owner's the owner, very difficult to enforce, and the potential under the Enterprise Law 2020 that the authorities can deem a nominee structure to exist and appropriate assets. There is a risk involved. So we would never advise someone to take that path out of first instance, unless it is a very particular arrangement that they have other protections in. So, but ultimately, when you're looking to, I want to set up something in Vietnam, I want to develop an entity, I have a purpose, set up the entity based upon what your need is. If you want it 50% foreign owned, 100% foreign owned, that's the path you take. Work backwards if you've got issues and restrictions and need to deal with it, but it's not about, do I do local or foreign? It's what structure, I'm a foreign investor, therefore we do foreign. Unless something else comes into it, it's a strange sort of way to look at it. And I know people do look at that way, but that's not the approach that we would suggest.
You just lead into my last question, and I was actually aiming at that advice level. What one advice, if you'd have to choose the key one, you would send to foreign investors when they're looking to enter the market in Vietnam, looking at the structure perspective at that first step? What's the most important for them?
Start with business lines, where your income's going to come from, because business lines dictate everything. So you work out where's my income coming from, what business lines do I need to achieve that, what are the restrictions, sub-licenses, obligations, commitments that I need, then work through it. Don't just set up a company and fix it later. Get that advice. So quite often, if it's a complicated area, we would approach it by a letter of advice, understand the requirements, the steps, the restrictions in what I'm looking to do, and then plan your attack. Do I do a 3-layer and complicated structure, as I said before? Does it go through a certain path? Is there a certain issue? For example, if I'm going to do something to deal with recruiting or labour outsourcing, where I need to have a certain number of employees, a certain amount of space. Education, certain number of space, certain number of teachers. Can I do that at the start, or is that a second stage? Do I just incorporate a simple consulting company and then add my restricted business lines later? So it's those business lines dictate how the structure is going to be and the timing, and never just rush into it. Have a plan at the start. Understand what those business lines mean. Get that plan, letter of advice, or a structural plan, and then follow that through to meet the objectives that are business line driven. Those business lines are everything. So that's the advice, and that's where I'd start from if I was looking at it.
And that matches as well the way we approach discussions with future clients. First thing we do is let's understand your business lines, your goals in country, and then we can follow up with the strategy for your entry.
In fact, my approach generally is, and I believe yours too, is that where's your revenue going to come from? Because that revenue should be support the business line. So the question is, where's the revenue? Well, we can get an invoice for this. Okay, does that match the business lines? Can we fit them in? What business lines need to arise from that revenue? And business lines are the key, understanding the revenue, understanding where the income, and then working down that chain. The first questions you need to ask.
Matthew, our time is up. Thank you so much for these wonderful insights, and look forward for our next episode.
Great to talk again, and look forward to the next one myself. Thanks, Vlad.
Registering a business in Vietnam can be a complex exercise for investors seeking to take advantage of the growing Vietnamese business market. And that is why we always advise investors to carefully assess their market entry options. Be aware as well of the latest changes in laws from the authorities, and take an informed and calculated decision when they are ready to set up their operations in country.
And many thanks to you, our listeners, for tuning in to Advancing Vietnam podcast series. For more information about this topic, please check out our publications on vietnam.aclimb.com. And if you want to reach out to us for any additional details, feel free to contact me on LinkedIn or throughout the website contact details.